Chop, chop, all my young homie. All my young homie. Chop, 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 all my young homie. Chop, 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 chop.
What is up, everyone? Michael Manoskinen here for the next round of live office hours. So today, what we're going to focus on is analyzing a co-living investment. And just to put that into quick perspective, what co-living is a rent by the room rental strategy. Basically, you buy a big enough house, or you buy a big enough house with a bunch of bedrooms and rent them out by the bedroom, or you get a really large house that may not have a lot of bedrooms and you convert the common areas to bedrooms. In my opinion, and based on a lot of data and analysis, this is the number one strategy for real estate investors who are serious about achieving financial freedom and building wealth. It's like the number one go-to strategy because you get more cash flow. You're able to buy bigger and better properties in nicer locations. So you get more appreciation. So you get, the properties increase in value more. You get bigger debt pay down as the properties are worth more. Your tenants are paying down your debts more quickly and in larger amounts. And because the properties are worth more, you're able to get more tax benefits as well. So when it comes to both cash flow that leads to financial freedom, it puts you in a much better position. And when we're talking about wealth benefits, it's not comparable to any long-term rental or other strategies because you get much better wealth benefits as well. So that being said, today what we're going to do is we're going to analyze a co-living investment opportunity and see if it makes sense for you or for anyone else who wants to buy those deals. So with that being said, let's get right into it. So if you don't know who I am, I'm Michael Manoskinen. I've been able to go from $0 to $2 million of real estate in my first 2.5 years of investing, and then scale to over $22 million in the last 2.5 years. I've been able to do so by leveraging what I call my super investor blueprint, which is combining creatively financed acquisition strategies, raising capital to buy deals, as well as the co-living management strategy to be able to buy more deals in more markets and to do so using little to none of my own money and basically fast track my path to freedom. So with that being said, let's get right into it. I'm going to start with screen sharing. And we talked about co-living, but what we didn't talk about was what's a great property. Like, how do you know what's a great property to do co-living in? So let's get right into that. I'm going to pull up I'm a visual person, and I think most people are. So I'm going to show you exactly how you're going to determine that for you. So let me do that right now. I'm going to start screen sharing. It's going to take me half a second. All right, so the first thing you're going to want to do is you're going to want to go on my Instagram if you're not already on there, because I'm going to just give away a ton of stuff for you to make your journey way easier. So if you go to my Instagram, which I will show you exactly how to do. So let's start with screen sharing. Share screen. Let's do the full window. Excellent. All right, cool. So if you go on my Instagram, all you got to do is you go to @MichaelMNAT. I give you tons of tools and resources to help you on your investing journey. Whether you're focused on co-living or not, it's ultimately up to you. But the first thing I'm going to reference is this link in my bio. It shows you my buy box. What is a buy box? It is telling not only myself, but the world out there, what types of investments I'm looking to buy and how they can bring those opportunities to me. So when I click on the buy box, it leads to this link, or here, let's just do it right there. It leads to this link. So there's a lot of stuff on here. I have my free Wealth Through Real Estate school community, tons of free trainings, tools, and resources in there for you. You're more than welcome to click this link and sign up. Obviously, my YouTube where lots of long educational content is hosted, as well as my Instagram. And with that being said, you can get a free creative finance calculator to help you analyze deals, whether you're focused on co-living, which is my favorite, short-term rentals, mid-term rentals, or long-term rentals. Or the way I analyze is I typically look at multiple exit strategies. You can do that all in this calculator. You can analyze traditional, like if you're buying properties the traditional way, cash, or you're going the creative finance route. It allows you to analyze all different types of investment acquisition strategies and management strategies. In my opinion, well, actually, I know for a fact there's nothing like this out there, and you can just get this absolutely for free. There's an amazing free version available for you. And then, so let's get back to the buy box. I am looking to buy properties that are great for co-living. So what does that mean? I'm looking to buy properties that are currently built and larger. And ideally, I take a property and I convert the common areas to additional bedrooms. My ideal end goal for a property is to have 7 bedrooms minimum, if not 8 or 9 bedrooms. I'm looking to buy these properties in major markets only, and I'll explain why shortly when I reference one of my favorite tools, PadSplit, and I've got a link here for you if you're interested in signing up for free for that. But so what I'm going to be looking for is a minimum of 3 bedrooms, 2 bathrooms, and minimum of 1,700 square feet. That's on the absolute lowest end. Ideally, I'm looking for 2,000 square feet or more, ideally 4 bedroom, 3 bath minimum. But there are certain opportunities, depending on the structure, where a 3 bed, 2 bath, 1,700 square feet could work to become a 6 or 7 bedroom property. As long as the debt is really solid and it doesn't cost a lot to get in, I'd consider that, especially when there's garages and things like that. So that's why that's my minimum. What I'm looking to get to is ideally 8 bedroom, 3 bath minimum is really where I'm trying to get to. We'll say minimum is 7 bed, 3 bath, but that's after I convert. After I convert the property, after I take it and renovate the living room, the dining room, if there's a garage, if there's office spaces, convert those into bedrooms. That's what I'm trying to get to. But most property, there's not a ton of 7 bed, 3 bath, 4 bath properties available, nor are they available in city centers, or are they going to be very price effective. So that's why you have to kind of convert properties this route, or you build from the ground up to make properties like this. I prefer creatively financed deals only, and an absolute requirement is I don't want an HOA. I don't want to deal with communities where there are HOAs, because I don't want someone to jeopardize my business because they have a bunch of free time available in the middle of the day to go cause complaints and all that. Like, I just don't want to deal with that. So no HOA is a must for me. Ideally, the less I have to renovate the property, the better. If it's lower entry cost or lower interest rates, even better. But that's not a requirement. That's preferred, because I'm here to analyze deals and see which ones make sense, regardless of interest rates or entry costs. I've bought properties with $100,000 entry cost that are phenomenal investments. I bought properties with 6-7% interest rates that are great co-living rentals. It really just depends on the deal itself. I'm only looking to buy in major markets. That is because that's where the highest demand is for the rent by the room strategy. But also, that is where you're going to get the most appreciation. I mean, that's really what it is. You're going to get the most appreciation, more guaranteed in larger markets. And there's going to be a way better supply of tenants looking for housing. So you don't have properties sitting there. My cheat code is leveraging a platform called PadSplit, which is the next thing we're going to go to, where I pretty much leverage their data to tell me where I should invest, or especially now that as they continue to grow. And the idea is, with PadSplit, they are a platform. They are the equivalent of what Airbnb is for short-term rentals. PadSplit is the equivalent for the rent by the room strategy. The awesome part about this is that they have so much data that is completely free for us to utilize and look at to decide where should I buy, and then what is the data in those markets? Like how many properties are currently available? How many people are currently looking for rooms? Of the properties available, what's the average occupancy rate, right? How many of the rooms are filled up? For each one with a private bathroom, how much is it renting for? Shared bathroom, how much is it renting for, right? They give you all of that data absolutely for free. You just need to sign up for the PadSplit platform to get that. If you want a link to sign up for free, here you go. You sign up for it. It's right here in my bio, and I'll show you exactly what we're looking for now. The core markets that I prefer: Atlanta, Phoenix, Charlotte, Vegas, Raleigh, Denver, and most major cities in Florida, as well as in Texas. So when you sign up for your free PadSplit account, this is the kinds of tools you'll have access to. This is a map showing you where does PadSplit operate, right? They are the ones spending all this time, money, and energy identifying where they should expand their business, where they started in Atlanta, Georgia, right here. They've continued to expand their platform and their resources in all these markets. The blue markets are their core markets where they currently have rentals, especially a decent amount of them. Emerging, these gray ones, is where they're expanding to. So you're leveraging their market research to determine where should you invest based on their data, right? If you're someone like me that is analytical and wants to minimize your risk, well, the best way to do that is to have a lot of data for the investment decisions that you're looking to make, right? So the more successful properties in a location, the more clear I am about how much income they generate, the more clear I am about how much demand they have, how many tenants are looking for properties relative to the number of properties they have, the better I can make an investment decision and minimize my risk when I'm buying something like this. With that being said, let's get right into it. PadSplit is not the only platform for this kind of stuff. You can look up like Zillow, for example. That's a listing. All right. So Zillow, you can go and do the tedious work of going to properties for rent. Platforms are shifting towards this model. I've made the case over and over again why this is only going to continue to increase. Housing unaffordability has only gotten worse. Higher prices that are sticking, higher interest rates are making it unaffordable for people to buy their properties, especially like homestead buyers. They're the majority of people that make $75,000 or less income are spending at least a third, if not over 50% of their income just for housing and utilities. There's a huge demographic, especially young working professionals and just really anyone under $75,000 of income a year. That's right. What's that, like $5,000 to $6,000 of monthly income that are looking for affordable options like this. They're looking to save on the rent that they're paying so they can enjoy their life. They can travel more, they can save and invest, they can eat out more. They want to spend their money on experiences, not housing. We are able to provide that solution, especially as this problem will only get worse. Housing prices don't go down. They go down in certain periods, but they do not go down over the long term. Interest rates have fluctuated up and down. We saw this crazy low interest rates between 2018, 2019, all the way through 2022. I took advantage of buying lots of properties traditionally that route, but also I continue to take advantage of those low interest rates by buying properties creatively financed. That's why I buy properties creatively financed, so I can still take advantage of those low interest rates. For the majority of people, they don't know how to do that, how to structure those or anything. Well, I can teach people. I teach people exactly how to do that in my super investors community, how to buy those deals as easy as possible. And I'll show you a few tools and resources for that. But rent by the room is going to be more and more and more popular as housing prices continue to increase and wages do not match the increase of inflation. So with that, if you want to look for properties on Zillow, for example, which is way harder, if you want to look for rent by the room data, you go to home type, you select houses, and instead of entire place, select room. And you'll see the rent by the room properties available in the market. You want to filter by certain things, you can do that. So you have if you choose a certain market, you can do that, right? And this is really good to compare your data from PadSplit to these markets. And I'll show you how granular PadSplit can get as well. But you don't get you can kind of see it, right? Up to a certain point. But it is not as easy to use as the PadSplit platform. And PadSplit is literally geared exactly towards this. And what Zillow doesn't do is they don't aggregate the data for you. Does that make sense? They're not putting together the way PadSplit does it, where it's like, hey, instead of a bunch of little dots like this, which is great, you need data like this. PadSplit is quite literally telling you, hey, look at all these blue markets. You click on a blue market, then it's aggregating the data for you. It's telling you in these, well, let's see what it says here, right? For Atlanta, Georgia, the city, this whole area that they have, including some of their secondary markets as they expand out, they have 7,428 active units. That's how many properties, how many rooms are currently available for rent, with 315 more being added on right now. Like their listings are actively being generated. They've had 35,000 searches in the last 30 days for housing. Let me move my big old head. Oops, I made it even bigger. They're telling you for this whole area, $176 per week, shared bathroom, right? They're saying that's on average how much people are paying for a shared bathroom. And those that have a private bathroom, they're paying $265 on average. 87% of these almost 7,500 units are rented out. And it takes 8 days to get the first booking when your property is listed for the first time, and around 30 days to 80% occupancy. Understand that these are averages. Your goal, especially in my opinion, especially if you're trying to be a super investor, is to always beat the averages. You want to analyze these deals based on the averages. So we have a property, one of our properties in Georgia. We got it 100% occupied in less than 30 days. Our first booking was in 3 days. We have rental income by the room or for the shared bathrooms that are higher than this. Understand though, these are the averages, and you want to get more and more granular. You look at the zip code where your properties are located. So as you can see, it's broken down zip code by zip code, and every zip code is different, has different data. So you can say, okay, for the 30310 zip code, there's 265 active units. Prices tend to be higher with a higher average occupancy, faster for first booking, and faster to 80%. One rule of thumb I'll tell you is that the closer you get to the city center, the better the income and the more quickly your properties are occupied. That's a general rule of thumb. Additionally, if there are major, like here's one next to the airport, when there's major employers or like a major demographic for kind of the rent by the room model where we actually own a property here, you will see that there will be higher income. There'll be higher income and more quickly will the property be occupied and higher occupancy. When you are looking at the whole market, don't get confused by just looking at these numbers. This can help you identify, is this a city I should focus on? Atlanta being my number one city, by the way. This can help you decide that, but when you're analyzing a deal, you need to get very granular. So between leveraging the zip code data, if you use my link to sign up for PadSplit, you can talk to the same representative I've used for the last couple of years. She can provide you more so like street by street, like house by house data as you reach out to her and her team can. Or you can also leverage other tools like Zillow and many others to get more granular data, right? You can see, all right, you have this 1 bed, 1 bath. You can see the photos. You can see all this stuff. You can see how many days it's been on, how many contacts. Understand for the rent by the room strategy, a lot of the times these will be absolutely like running. These listings will stay live indefinitely because they want to continue building the database of people looking for rent by the room. So understand that that is a possibility. That it might show if 180 people contact, that means this probably got rented. That's a lot of people contacting for this property. But it's still sitting there as a listing because of the fact that people are actively looking for housing, for rent by the room over there, and they want to keep capturing that. So you can do this like zip code by zip code, street by street. And I wanted to give you that so you understand where the data comes from and why PadSplit is my biggest cheat code when it comes to gathering this data. Additionally, PadSplit will help you manage your property. And I put that in quotes because they help manage in the same fashion that Airbnb helps manage the co-living model, helps manage the short-term rental model. They are a platform for tenants to find your property, people who want to look for the property to rent it out. They help with the guest communication component. They help with the income and maintenance requests. They help the communication, income, and get tenants in your property. It's still up to you to move in your tenants. It's still up to you to send out a contractor or a handyman when there's maintenance requests, right? It's still up to you to do that work, that piece of the management, or outsource that to a property manager. But it's imperative to understand that this is like a huge cheat code, not just for the data, but for getting tenants to find your property. It's like trying to do short-term rentals without an Airbnb or Vrbo. Is it possible? Of course, but it's harder, right? And there's a trade-off in that, and it takes more time. So with that, we've seen where you grab data. What we're going to do is we're going to just choose a few key markets. We'll just understand that my markets come from pad split. That's where my markets are generated from, some core pad split markets and their data. And then what we're going to do is, because I prefer to buy my properties creatively financed, well, where are you going to find these deals? Well, if you're in real estate investment communities, Facebook groups, whatever, you can go talk to, you can either generate your own deals, which is a strategy, something I don't do as much anymore, or you can buy deals from wholesalers or get bird dogs to find you deals. Those are higher leverage use of your time to get people to bring you deals that make sense for your buy box. And then it's your job just to analyze those deals, not talk to sellers or agents or any of that stuff, but it's to understand what do you want to buy, analyze it, and buy those properties. I do that. That's a main strategy, but I also have a database of these creatively financed deals that are live at any one time that someone can go and buy these deals if they choose to, that are all creatively financed with all the data there. If you are someone that is looking to buy these deals and you don't even know how to get started, go into my free Wealth Through Real Estate community. I have trainings for you like creative finance investing. This is how to analyze different deals and why I prefer creatively financed deals. How to analyze various deals, that's in there. There's a section for co-living deal analysis in particular to get it more granular. But also under the Financial Freedom Blueprint, there's a resource here. We'll go all the way to the bottom. There's a resource here called the Creative Real Estate Investing Checklist. Or no, this is the calculator. So it's the free calculator. And then here's the checklist. So you get this information and you know, okay, if I'm buying a deal creatively, what information do I need? Well, the main advantage for super investors, people in my paid mentorship, is they have access to a database like this one. I got to put in a password, so I cannot show you guys that. Just one second. This is password protected for, I want to show you how to analyze this deal. I can't give you the platform that we use to buy these deals. But so you can go in and you can get all the information you need to be able to buy these deals. If we just focus on the markets that we're interested in, let's say Arizona, Georgia, and these are all creatively financed opportunities. Let's say we're cool with Texas. We won't do Tennessee right now. We'll do nothing in North Carolina right now. That's fine. Let's stick with these ones for right now with the main emphasis on Georgia. So there's this one. It's a high interest rate. Let's look at properties that are at least 3, 4, or 5 bedrooms, at least have 2, 3, 4, or 5 bathrooms. We want, for this analysis, we only want deals that are hybrid, seller finance, or subject to, my favorite creative finance strategies. And then we want at least 1,500 or more square feet. So let's just choose one, and then we'll actually start analyzing these deals. Let's see. Oh, no HOA. Like I said, that's a must. So it's nice to be able to just automatically filter those out. No HOA at all, please. There's this one in Phoenix that could be interesting. It's a much more expensive property, so it may not be a great fit, and it's got a big monthly payment, but let's see. This one could be a good candidate. If this long-term rental estimate is correct, this could be a good candidate because you can always help renegotiate these deals. This is a straight subject to deal, right? So there's less you can negotiate because the mortgage is already in place. But depending on the square footage, you can add significantly more rooms here. Let's see if there's I'm a Georgia guy as much as possible. So let's get rid of Texas right now. I don't want to deal with Texas. State, and get rid of Texas. This one in Atlanta. This one looks, I'm not a fan of that right now. So because I've looked at lots of deals, I can quickly determine the ones that I don't even want to waste time on. That's the point you want to get to. You're not going to just analyze a deal and it's like the perfect one. You want to get to the point where you understand your market so well, you can quickly choose the ones that might be worth looking more into. So let's stick with, all right, let's go with the 30228. Let's see what we got here for 30228 on the pad split platform. So it's a little further out. Let's see what data they have. Not a ton of data, 15 active units. So this data, the less units that are available, the less accurate this information is. It could just be that the property they had really phenomenal returns and whatever. Like, the less units, the harder it is to analyze. I would say you want at least 50 units, if not 100 or more units, because 15 units could be 2 to 4 properties potentially, right? Because these are a number of bedrooms. That is not a ton of data. Let's see if there's one with more data. Otherwise, we'll stick with that one just for the sake of analysis. I really like 30116. Let's see how far that is. Sometimes when you select a zip code, it has a hard time. So it's easier just to refresh and then just select another zip code when you like search the zip codes. Or it's not one of their core markets, so let's not waste our time on it. The goal is to know how to get the data and analyze these deals. So, all right, let's stick with the first one that we had. Was it this one? 30. Let's verify if this is the one that I've already looked at, which needs some renovations. Let's take a quick look at this property. Okay, cool. So it's like photos, but not really. We can always just type these addresses online too. Let's see what we got. So this is still active on market listing. Oh yeah, this one needs some decent renovations. We don't want to touch that for the sake of this example. We don't mind adding bedrooms. This one's really high. 30311. Let's try this one again. This one's solid location. Maybe we'll stick with this one because there's going to be good data. Yeah, so 257 active units. Let's go with this one because it's a great analysis. So what did I just do with it? Here we go. We're going to analyze this investment property. But before we do that, let me explain the calculator that we're going to use to do that. So this is the Super Investor Real Estate Calculator. This is the version provided to super investors. This is a paid for calculator only through my community. There is a free version of this. So don't worry if your goal is to just start analyzing deals, because you can do all of the same things except for the capital raising component and some of the automations that make your life easier. But for the analysis sake, it's all there. So I've zoomed out a lot. Let me zoom in a little bit. So just to run through the calculator and then we're going to start analyzing, I just want you to see it first. The property information, entry cost is, okay, what is it going to take to get into this investment? This is the debt terms. What is it going to, like, how are you going to be able to structure this deal? How are you going to buy it, right? How are you going to buy it? You're buying it subject to seller finance. Is it a hybrid creative deal? Is it a traditional or DSCR loan? Are you buying it cash? Depending on what you choose, that will then tell you what information you need to consider. Subject to, hybrid creative, whatever. These are what this will then spit out is your fixed expenses. So depending on the debt, that'll be here. The monthly debt payments will be here. If it's seller finance, there'll be a component there as well. There's taxes, insurance, property mortgage insurance, HOA, because if you're buying a property for long-term rent, midterm rent, short-term rent, co-living, doesn't really matter. This stuff is all the same. There's a little bit of components for the creative financing if you have to recreate the loan right here for the seller, for the subject to or seller finance. So here's the subject to loan terms. You have to recreate that loan to be able to analyze it correctly. If there's a balloon on the subject to or seller finance, these terms are brand new to you. Please go watch my free trainings. This is more of an intermediate training at this point. And then if you want to analyze deals as long-term rent, co-living or rent by the room, midterm or short-term, you can do all that in here. And depending on how many strategies you analyze, this will tell you what is the best cash on cash return for the strategy you're going to implement. You can also just select, if you say, hey, I know the best is co-living, but I want to do long-term rental, you can do that. And that's like spits out automations for that strategy. Some of the benefits for the Super Investor Calculators, once you analyze the deal, you then are able to very quickly determine if you bring in a private money partner, what percentage of ownership should you give up, and what returns would they get on that investment, right? So it makes the cap raising way easier. Or if you go with a private money lender, after you pay all your interest to them, right? Like how much loan can you take out? What interest can you pay them to still be cash flow positive? So you have infinite returns. When you are starting out real estate investing, you're more likely going to use your own money. That's just kind of the way most people start. If you start raising capital, you need to understand how you're going to structure these deals. What are you going to get left over, and what are the returns for your partner? If you put some of your own money in there, you want to understand, okay, if I put in, let's say 25,000 and my partner then puts in 99,000, what are the returns for everyone? Or if you do what I do and you put in no money and your partner brings in all of the rest, what is their cash on cash return, right? What is their cash flow relative to the amount they invested? What is their total return on investment, right? What are their total benefits between cash flow, tax benefits, debt pay down, appreciation? What are their total benefits versus the amount of money they have to put in? This part is way easier when it's automated for you. That's a super investor cheat code. You want to be able to analyze these deals, not just in the short term, but in the long term, and all this is automatically done for you. It gets spit out here, right? What do the returns look like over a 20-year horizon? And if there's wiggle room for negotiation, it'll automatically give you some additional changes you can make to be able to analyze those deals. And then when it's time to raise money through private money lenders or private money partners, all you then do is just screenshot this and put it in your cap raising pitch decks that super investors get access to, the pitch decks, the templates, all of that stuff. Then they plug into the super investor CRM that I provide them, a free CRM. Well, it's not free. I mean, I pay for it. They get access to that. And then they leverage that for their capital raising to make that whole process easier. Nonetheless, the free version allows you to do all of this analysis, and then it's up to you for the capital raising and all that. That's really ultimately up to you. So with that being said, let's get this deal. So it's 1571, and then let's analyze this investment. So let me share this screen where I got it side by side. So we're going to go this route, and we said 1571. One thing I want you to understand is the deals on this super deals database, they are not my deals. I don't go find these deals. These are not just the ones for me to buy, whatever. These are deals from wholesalers. And then we have it set up in such a way that they have all the right information we need to be able to analyze these deals and make very quick investment decisions. Like I said, you can go talk to wholesalers, build relationships, all that good stuff as well. This is just one of those cheat codes, higher leverage use of your time. Instead of chasing down people and wholesalers and all that, you can add that as a portion of what you do, but your goal is to buy deals. To buy deals, you need to be able to analyze deals. To analyze deals, you need to get leads in your inbox. The more leads you have, the more potential deals you have, and the easier that process is, the more easily you can then analyze and choose which ones you're going to buy. All right, so this deal, we've got 25 minutes to analyze, so let's do it. So we're going to put the property information. This is currently a 4-bed, 4-bath. I love that ratio. This one is 2264 square feet. So it means it's pretty built out. So we'll see. There's not a huge amount of extra rooms that we can add, but we'll see. It really depends on the flow of the property. All right. Let's see how many rooms we're going to be able to add to this property by looking through some of these photos. So they have an unfinished basement. So this is something you could potentially turn into a room or two. And that's usually not accounted for in the square footage. This one's obviously a bedroom, smaller one, but it's a bedroom. Huge closet. That's awesome. This is like a master suite. So when you see the data for pad split here saying that private bathroom, like this is really what we're talking about. Like these ones generate the highest amounts. We have some that are like 280, 289 in this market because they're just really phenomenal properties. Especially when we're buying properties that were previously short-term rentals, they tend to have really awesome master suites. Okay, this looks like already a bedroom. Already another bedroom. What is this? Is this a kitchenette? I don't think it's a full. We'll look at the description right after this. This could be a bedroom depending on the layout. Sometimes when you search the listings, they have, here's a full kitchen. Okay, good. Much better view. So there's one shared bathroom. A lot of driveway space, which is great. You're going to want a lot of parking there, which is phenomenal. We'll then want to make sure street parking and all that. We don't have time. We're going to focus on analysis during this. All right, so it's like a repeat of the photos. Let's go on the internet and see if we can find more. So 4-bed, 3.5 bath. They're trying to rent it out right now. So maybe it is, maybe it isn't for sale. We'll see. Let's see when they decided to make that. Maybe they just. So they removed the listing early June. And they try to rent it and then listed it. I don't know what their goal is. So that's another thing. We'll have to figure out what that is later. So let's see what the description says. Near 2 golf courses. Yep. Unfinished basement, unfinished. So that's at least another bedroom or 2. All right, let's see if we can find the previous sale listing. Sometimes you could find that instead of the rental listing. Or sometimes you can find a layout or floor plan in these types of listings. Let's see if they have it at the end. No, they don't have a floor plan or layout. Something I've asked people to do is I will reimburse them. Like I go get a floor plan or get my contractor to do that immediately, so I get a much better idea. I mean, this is at least 2 bedrooms, but it's going to cost much more to finish than it would cost if it was just like converting a living room to a bedroom. That's the unfortunate reality with that. Let's see if we go on Zillow, if there's any more. Let's see, Redfin. Sometimes you can have the for rent has unfortunately taken over, and we don't have the time to go and look at PropStream and all this right now to get a better idea of the previous listing or talk to an agent to get the previous MLS listing, because sometimes they have it in there as well. Oh, this was not a kitchenette. I mean, it's like a bar more than anything else. All right. We're going to have to make some estimations until we get a contractor there, which is fine because we do that literally all the time. See, yeah, it's removed from the MLS. But that data is still there. Like agent can tell you. Okay, so off market. So this was, let's see if this has the information from before. This is another like cheat. You can kind of see, like sometimes it'll say the number of rooms. I don't see that fully in here, but we have 3 bed, 3 full baths, and then a half bath. $2,213, yeah, and then there's the unfinished basement is another $1,000. So each bedroom typically is, you want it to be no less than 10 foot by 8 foot. That's the minimum, and ideally 10 by 10, which is 100 square feet. So or 10 by 10 is 100 square feet. So that unfinished basement can turn into many more bedrooms. You can assume 3, but it's going to cost more than it would to convert a bedroom. That's why you're really going to want to get a contractor on that. But let's move forward with the estimate that this will be a 7-bed, 4-bath. So we'll put 1,000 square feet, unfinished basement. Key thing here is that you saw, right? They have a lot of stuff down here, and there's a little bit of awkward. So like 1 could be there, and then maybe another 2 here, and this all has to be blocked off, obviously. Potential for 3 more rooms. Okay. So what we're going to do now is let's get to the actual analysis. Someone asked about the slides. Like you want, like my YouTube, it's all there. These are the slides. If you want that, that's my free Wealth to Real Estate School community. That's where you grab all that stuff. Let me drop that in for anyone. I got some people on Instagram as well. So it's my free Wealth to Real Estate community. But then also, obviously, most of you guys are watching this on YouTube. So that's there as well. That's where it all is. I mean, if you want to be part of the paid super investor community, it's a whole other thing, right? But that's where all this free information, data, tools, resources are at. My Instagram has a lot of these tools already linked into it. So let's get into the actual analysis. We've spent a lot of time just talking about it. We saw one bedroom is going to have at least a private bathroom. I would assume at least 2 of the bedrooms have a private bathroom and the other 2 share. So what I think is it's going to be is we got to get someone there, right? This is the next step. Once you analyze the deal, it makes sense. You send a contractor, you send someone boots on the ground, you talk to the agent, you get a more clear understanding. You can't just do that from just looking on the internet always. So 2 with private baths and the other 2 plus new 3 share 1.5 baths. So between the other 5, they're going to share 1.5 bathrooms, right? They're going to share 1 shower. That sucks. That might be the potential. Actually, no, there is no potential to add a shower because there is no potential to add it because of the fact that there was no, I think it's just a sink and toilet, and I think it was a very small one. That's another thing you'd want to verify. All right, so let's get to the right here. All right, so let's go into this deal. Let's get into the creative finance, and then we'll get into the analysis. You want to understand what's your plan for this property. Is it even viable before it's worth even analyzing? Because this is the easiest part. In essence, it's way less time consuming than doing a full analysis. It's just seeing, does this make sense? Does this HOA, is this a no-go for me? Does it have things that I don't want it to have, right? Is it too small? So this is a straight subject to deal. This is a straight subject to deal. And for the sake of analysis, what we're not going to do is we're not going to go and pull the mortgage information from PropStream and all that right now. There just isn't the time available. And sometimes that gets my videos kicked off. So sorry. So your investors, you guys get access to that kind of stuff, but I can't go through all that right now without potentially getting this video kicked off. So the purchase price is $519,271, right here. The entry fee is $37,000. One thing I want you to consider when you're analyzing is understand if it's a straight subject to deal, that means all the cost is to buy the property should be the wholesaler commission, agent commission, cash to seller, plus the mortgage balance equals the purchase price. Okay, so understand that. And in this instance, we have 519. We have the mortgage balance is 482,270.52. And then we're going to have here, see, it says errors because this minus this does not equal this. When we change this to 37,000, well, it should equal that. Let's see. Might be a few cents off. So 591, let's check it, equals 591,271 minus 37. What did I do? Oh, I went dyslexic, my bad. 519. 482,271. Yeah, I mean, that should be right. It could be this, just get rid of the cents in that scenario. There we go. That was my fault. That this is accurate, right? But the cents said this math is not 100% right because there is, that means this one has the same amount of cents added to the end. That was another way you could have done it. Whatever, that's not going to make or break your deal. So the subject to loan payment, just the loan payment itself is not $4,459.17. This loan payment, this PITI is the principal and interest of the loan plus taxes and insurance, right? It's the loan plus taxes and insurance is how that is calculated. That's what the PITI is. That's what your mortgage payment is. Because we're not going to recreate the loan right now because we can't pull up the information from PropStream and all that right now, what we're going to do is we're just going to overwrite this loan amount to this amount. It's going to mess up some of the debt information later, but for the sake of quick analysis, till we can get a mortgage statement, this is the way you would look at it to see if it cash flows or not. It doesn't really matter what the break is until you know if it makes sense, financial sense or not. And we're going to know that by the number of rooms and how much they rent for and what the expenses will be. So with that being said, because the sub 2 loan payment is already accounting for the taxes and insurance, we're going to set these to 0 right now. Okay. We've got the debt information. All right, we've got the debt information. Your first payment, we'll say it's the start of next month, 8/1. All right, so we have the monthly debt payments. We're going to zoom out and we're going to go to the entry cost now. How much does it cost to get into this deal? So the way a lot of wholesalers structure this $37,000, it's not just the cash to the seller. It's the cash to the seller, their wholesaler commission, and the if there's an agent commission involved. But you separately have to pay your closing costs, renovation costs, reserves, all that kind of stuff as well. So for the sake of analysis, until we get a breakdown from the wholesaler, is you already know the agent commission is included in here. And you already know the assignment fee from the wholesaler is included in here. There is no acquisition fee right now. This is if you find a phenomenal deal and you're raising the money, you can sometimes get paid at closing for this deal. You don't add that until after, depending on what the deal returns are. And some people never add that, and that's fine too. What you do want to account for is your closing costs for the loan, because that's not accounted. You see, it says, a lot of times you'll see this, plus CC plus TC, right? Plus your closing costs plus transaction coordinator costs. We have that in the admin reimbursement costs, separate from this closing cost, paying your transaction coordinator, paying for you to form your LLC, paying for an inspection. You have to account for those costs as well as part of your closing costs. But I typically tend to fund that and then get reimbursed by a capital partner. So as someone who knows I'm going to raise money, I account for that in a separate line so I know I get paid back at closing that amount. And this is just basic renovations and furnishing costs. This is not to convert it to a co-living rental. This is just to clean it, renovate it, whatever. Very basics kind of thing. $1,000 is a great placeholder to just basically get it cleaned up really nice. And then carrying costs are going to be 3 months of your total reserves, which includes your fixed expenses plus whatever strategy you're using, some of those expenses, saving up a few months of it to get your property while you're renovating the property, furnishing it, getting it listed and rented out. This is the money that's going to cover those costs, right? So just to get into this deal, they say $37,000, but with closing costs, carrying costs, your reserves and your all that, it's actually closer to $67,000. Now we're going to go the co-living route. Now we need to analyze it for a co-living rental and the additional costs associated with converting it to a co-living rental. So what do we say in the notes? We said we're going to have 3 more rooms in the unfinished basement. So for the sake of this analysis, we're going to say 3 more bedrooms, $7,500 a bedroom, $22,500. I would probably, because it's an unfinished basement, and this can really range between $5,000 to $8,000 when you're converting a office space, a living room, a dining room into a bedroom, like adding some walls and a door, right? That can cost you between $5,000 to $8,000 on average, because this is going to be an unfinished basement where you're going to have to not just add walls, you're going to have to finish out. Well, you're going to have to finish out lots of things. Let me just show you. You have to finish out a lot, right? The ceiling, the flooring, the walls you're probably going to improve and add maybe better insulation, all that kind of stuff. You're going to have to block this whole thing off. It's going to cost more than the typical. So let's go with $10,000 for now until you get a quote from your contractor in your local market. All right. And then we estimate approximately $1,500 per bedroom. So not these 3 new ones that we're adding, right? This is 3 times 10,000 is the cost for the renovation for co-living. But to furnish the property, we have the 3 plus the 4 here. So 7 bedrooms times $1,500 a room is $10,500. So now your new entry cost to get into this deal is $108,000 to buy this co-living property, renovate it and furnish it, and have some reserves set aside for this investment. Why do we do the number of bedrooms times 1,500? Well, on average, it costs around $1,000, even less, like $800 to $1,000, depending on the bedroom, to furnish it. However, we still need to furnish the bathrooms, the common area, like the kitchen. If you're doing outdoor stuff, you're going to need to furnish that. That's why we go on the higher end. And the more bedrooms you have, in theory, the more you're going to have to furnish, especially with bathrooms and all that. This is another rule of thumb. You want to get more granular for that, but you can't do that on every single deal that you're analyzing to see if it's even a good fit to move forward. What we said is at the end, we're going to have 2 with private baths, and then in total, 5 with shared baths. So 2 private baths, 5 with shared baths. This is 7 bedrooms. I don't know if you saw that, but when it said adjust rooms, it's saying the number of bedrooms plus the number that you're adding, right? The 4 plus the 3 is not equaling the number you have set here for private versus bath. To fix that, you have to put in the right numbers. Here, once that's fixed, then the math works. We go to pad split in 30311. It says shared bathrooms rent for $179, private bathrooms share for $259. $259 and $179. I have a pretty bad memory, so if I can do this, you guys can do this. I'm also pretty bad at looking at maps, and I'm not overly creative. So I'm good at structuring numbers and deals, but you have a pretty good shot at this thing if you can keep up with me. That's really all you got to do. Let me add this bad boy for anyone who keeps asking me information. One thing to account for in this is when we're going subject to, you can estimate the loan amount. It's not really going to make a difference now because we're not using this. We're just taking the number and just plugging it in here for quick analysis. But you can put some key information on the loan right here. So like 7.25%. Oops. See, I did 5.2%. If you can do better than that, you're solid. So you can keep some key information. What I would advise everyone to do if you wanted to buy this deal is get the original, get a mortgage statement and leverage the data from PropStream to recreate the actual loan. That'll help you much more with the overall analysis. But for the sake of this, let's see if this thing cash flows and has a high cash on cash return. So we have our co-living entry cost, which is $108,000. We know what our income is for this property, right? It's $6,123 with 2 at $259, 5 at $179. So it's $6,123. Well, our mortgage, which includes our loan payments, taxes, and insurance, is already $4,459. I'll tell you right now, it's not a good sign. Your mortgage is 45% of your income, or that's not right. 75% of your income, right? 4,500 roughly divided by 6,000. 75%, that's not a very good sign if your debt is that much. Because you still have a lot of additional utilities to cover. Your insurance is going to be higher because now you're going to put in landlord insurance policy for rent by the room. So we're estimating $100 more a month for your insurance. Water and sewer, $150. Gas and electric, $150. Garbage, $30. Internet, $75. Landscaping, if you're offering landscaping, which you should, that's a huge issue. That tends to be a huge problem with who should do landscaping, and this, just pay for it. It makes your life easier. If you're going to offer house cleaning, this $100 is basically saying once a quarter, right? 100 times 3. So every 3 months, you'll send someone out for $300 to clean up some of the common areas. That's what this is highlighting. If you're going to provide any shared supplies like toilet paper, paper towels, whatever, those kind of common things, you can add that in there. I wouldn't get too crazy on this, but this is that's kind of a lower end for what you can do for that. And then if you're leveraging pad split, the platform, well, they're going to take approximately 12% of your rental income, 12% of this rental income. They're going to take that as a fee for using their platform. They actually take 8% of your monthly income, but they take 10%, or they take 100% of the first 10 days. So it's a lot of numbers. If you want to see, I've got a link in here that really visualizes this for you, but it's like they take 100% of the first 10 days, and then after that, it's 8%. Okay? That translates to around 12% of your total income, roughly. The more you have tenants moving in and out, the more you're paying pad split relative to the amount that you're keeping because they're taking those first 10 days. The longer tenants stay, the better the deal it is for you because you're not redoing those first 10 days over and over again. If you're going to leverage another form of management to do the back end, right, you want to account for that. I've seen it between like $200 a month on the lowest, like just a flat fee, all the way up to 8 to 10%, right? What we have in Atlanta is 8%. When we self-manage, we have 5% set aside for it, for our virtual assistants and my asset manager to provide some oversight for that, in addition to pad split. Sometimes you can just pay a straight up manager. You won't use pad split and you'll pay them 15 to 25%. Most of that is dependent on the market that you're operating in, right? What are the resources available? Where does it make sense to use pad split versus not? And then what are the fees each company in that market charges? You have to understand your markets that you're investing in. This is part of the analysis. This is just a general rule of thumb based on my numbers that can help you out. Then vacancy. So we saw in pad split, a 91% average occupancy, which means that 9% of the time it is vacant in this market on average. So vacancy is 9%. Maintenance and capital expenditures. The rule of thumb for a long-term rental is 10% of the rental income is That's what's set aside for maintenance and capital expenditures. But the reality of it is, just because you're making more income for a property doesn't mean your capital expenditures will necessarily happen more quickly. It's like you're not going to have to replace your roof any faster just because you have a one family or multiple families in there, or because you have a short-term rental versus a long-term rental. Like, that's not how it works, right? The roof is the roof. That maybe your AC will be used more, things like that, but not like your roof and structural things necessarily that you have to account for in your CapEx. So you want to make sure that your monthly maintenance and CapEx is higher than what it would be as a long-term rental. We saw here it said long-term rental is $2,771. 10% of that is $270 a month. So you want to make sure your maintenance and CapEx is higher for a long-term rental. And a good rule of thumb for that is around 6% based on like the amount your rent by the room income, like the amount that it increases versus compared to a long-term rental, like the percentage, 6 to 7% is a good one. Just make sure that it is always more than what your long-term rental savings would be for your maintenance and CapEx, because there will be more wear and tear and more maintenance for sure. Maybe not more CapEx, but definitely more maintenance for sure. So that being said, I can very quickly tell you the total expenses and reserves with this big debt payment is $7,219 a month. This, you're making $6,123. You see the issue here? Didn't matter that this was creatively financed or not. This property is going to lose you $1,000 a month as a co-living rental, even with creative finance. And I know exactly why. This debt payment is just incredibly high. Unless you can get something that you're able to crank out, even if you were able to, get this thing to be a 2-bedroom or 2 more bedrooms, right? If there was the space for it, you went 2 bedrooms and all of your costs went up from $108,000, it's $130,000. But you were able to do, you'd also have to add a bathroom now, right? So plus extra bathroom. Oh, you shouldn't add a plus there because Excel/Google Sheets is weird. So let's just say instead of $10,000, or we'll go here, add $50,000. We'll also add an extra $10,000 for that. And we say, okay, these will all share. So now it'll be 7 beds, 2. So this is 9 bedrooms now, right? 2 private, 7 shared. Even though your entry costs went up and your expenses are going to go up as well a bit, your income went up so much. Let's see if this now makes sense. It still doesn't make sense. The debt is so expensive on this deal, it's not going to matter anyway. That's why when people ask, why do I love creative financing? What's a bad example? This one is 7.25%, and there's a large debt. There's a large debt at a high interest rate. So you're spending a ton of money on the mortgage itself, regardless of the expenses, the other expenses and the income. It's just so expensive to pay this mortgage that the deal doesn't make a lot of sense. You can pretty much get a good feel for that. Like if you're going over $3,500 a month, it's really not going to make a lot of sense for the most part. Over $3,500 a month or $4,000 a month, it really starts to not make a lot of sense for that. And for me, you'll see I'm looking to buy deals, ideally, that are generating me at least $1,000 a month of cash flow and 15% cash on cash return. Your goals might not be as aggressive. You might say, I want to do $500 a month in cash flow, and I'm okay with 10% cash on cash return. That's ultimately up to you. That's your investment decision. This is my rule of thumb when I go with the co-living rental route. But because this is a subject to loan, like you're buying the property subject to its existing loan, you can't increase the cash flow. You can do it by adding more rooms. You can increase the income. You can try to decrease some of these expenses, but they're nothing crazy here in general. Maybe you self-manage and that's one of the things you do, but I wouldn't, like, that's barely making it work. I wouldn't do that. When you're able to renegotiate creative deals with a subject to loan, all you can change is the money down. Well, this $37,000, even if you got rid of it entirely, the property will not cash flow more. It just means that you get into it for less, so your cash on cash return will be higher. If your cash flow is negative, it doesn't really matter. In this instance, where we said it's $343 of cash flow because you have 0% management fee, is a 2.9% cash on cash return. So if we get rid of this, which is going to mess up some of the numbers, but if we just get rid of this, like you see, it's going to say error, it's fine. If we get rid of that, your cash flow doesn't increase, but your cash on cash return will increase. But there's not enough cash flow for the amount of entry in this that it doesn't make a substantial difference. So it's like there's no real viable way to make this deal work, which is great because you've determined this property is not worth your time to continue pursuing. That's like 95% of the time, most deals will not work. When you go creative, you're increasing your likelihood for it to work compared to like the traditional route. However, understand that the majority of properties out there are not great investments. That's just the rule of thumb. You have to analyze a lot of deals to see the ones that make sense. Sometimes you can renegotiate a deal, but not in this instance because the loan is already fixed. This was all seller finance instead. So instead of this, if this was, let's say it was the 37,000 and there's no loan, and this was instead of the 7% that it was, if you can, like, let's go back to how these numbers were. If it was all seller financed instead, let's get back to the 5%. The deal, what did we mess up here? Oh, because I hard coded the amount. Yeah, it's not great. I got to fix a little bit of stuff here. I'm realizing with some of the formatting. But the deal still wouldn't make sense. Well, in this instance, it does make sense. Why does it make sense? I have no idea for you. 3209. Oh, this is just the loan. So what we're missing here now is like the extra $1,000 a month that was going towards taxes and insurance. So you could do $6,000 a year, whatever. In this instance, now we're getting a lot closer to the numbers that we were at before. So $210, what you could do is say, hey, seller, I can't make this deal work at 7%. At 5%, let's see if it works. You're not changing the down payment, but you're paying them less monthly. Oh, I hard coded it again. Sorry, guys, I totally boofed this thing. Equals this amount. I got to fix the conditional formatting later. But now you went from less than 3% to 7.2%. You can say, hey, it still doesn't work for me. What if I buy this property instead of $519,000? I buy it for $530,000. So I'll give you $10,000 extra, but I need this thing to be at 3.5%. Your down payment's not going to go up, but whatever you pay them in the end, they're going to get more monthly payment as a result of this increase, and they're going to get more in the long term. Now we're at 10.5%. This is why seller finance and hybrid deals are better, because you have this wiggle room to renegotiate these deals, and you have more levers to pull. When it's subject to, you can really change the down payment, the money you provide at closing, but nothing else is really negotiable. That's why subject to is cool, but if you're buying deals with low entry and very low interest rates, when you're buying properties with, even if a lower entry, but a higher interest rate, and you're putting a bunch of money in to renovate it, like, it's probably not going to work, especially when the debt is so high on a property like this, even if it's in a great pad split market and a great zip code in that market. Hopefully that was helpful for you, understanding where to get all this data, where to get all these tools and resources. I have dozens of videos like this where I do get the mortgage data and subject to, like, all this stuff broken down much better. And I'll need to fix some of this stuff on my update to the calculator, which is super easy for me. All right, with all that being said, please make sure to follow along as I share tons of more value on my YouTube, my Instagram, as well as in my free Wealth to Real Estate School community. There's like literally deals for you out there. There's analysis and strategy and all that stuff in there, tools and resources to help you on your investing journey. So just follow along in that journey. And if you are someone that's looking to scale your portfolio through leveraging more creatively financed deals, more conveniently, raise money to buy those deals so you get infinite returns like I do, as well as leverage co-living at a high level to maximize your returns and ownership benefits, reach out to me to see if you're a good fit for my super investors community. This is a paid community, paid mentorship. It's not the right fit for everyone. And I get that. I want to provide so much free value to the majority of you guys. For those of you guys who want more support and more step-by-step guidance, the blueprint, tools, and resources that help you maximize your journey, reach out to me about super investors. All right, y'all, with that, thank you. I appreciate you, and I hope you all have a phenomenal evening.
All my young